Okay, hi guys. Welcome to my live stream. My name is Zahir Anwari, co-founder of Sublime Trading. We specialize in helping CEOs and high salary earners get consistent returns in the stock market using a simple and proven strategy, a repeatable strategy, and in only 30 to 60 minutes a week. And if you're here in the UK, we help people do that tax free as well. There's some very special accounts we have here that are free of capital gains tax. So that's always a huge advantage for us. Okay, so we want to end the week by having a look at the S&P 500 and potentially how the week could end. And how the week ends will, of course, have an impact of what we could see through the rest of next week and through the rest of December, and potentially even how the year ends. So a lot of information could potentially be gathered from the close of today's market. My preferred indicator is the S&P 500. I use the S&P 500 to guide my decisions on what kind of market conditions we're dealing with. If the S&P 500 is bullish, I look for strong bullish stocks. If the S&P 500 is bearish, I look for stocks that are weakening quicker than the S&P 500. And if there is a mixture of bullish and bearish factors, then generally I stand aside. And so 2022 for me has been a stand aside year. I still have some stocks open in my portfolio. For those of you guys who are regulars to my stream, you'll know I have stocks like McKesson, ticker symbol MCK, that is performing very, very well. It's up 60% this year. So there are lots of stocks that are performing well, and I've been holding on to these. But in terms of adding new stocks into my portfolio, I've been standing aside. And that's because there's been a mixture of bullish and bearish factors. If you look on the internet, if you look at opinions, a lot of what is out there is quite misleading, saying, hey, we're in a bear market and this is going to continue through the rest of next year. We want to stay away from that. We don't want to get caught up in that noise, because long term that won't have any positive impact on your portfolio. In fact, it will just cause you to lose money. So we want to look at the S&P 500, get an objective view what the market is doing, and let that dictate us. And once that's dictated our direction, we can then start adding the right assets into our portfolio. So let's get into the charts. This is a typical 3-screen setup of mine. In the top left, I have the monthly time frame. In the top right, I have the weekly time frame. And down here across the bottom, I have the daily time frame. So instantly you'll notice that I'm looking at the higher time frames. This allows me to catch the bigger moves in the markets. I'm effectively a trend follower. So what that means is when the market's dictated a direction, i.e. a trend, I then go in that direction. Now, I don't invest in the S&P 500. This is a really important point to understand. The S&P 500 is an average. It's an average of a group of stocks. So if you invest in the S&P 500, you'll get average returns. And don't forget, when you have declines in the S&P 500, you'll be faced with significant declines in your portfolio. It's a great place to start, investing on a monthly basis into, say, an S&P 500 tracker fund, for example. It's a great place to start. It's certainly better than leaving your money in the banking system. But in terms of getting good, consistent returns, you want to use the S&P 500 as your indicator of market conditions, and you then want to find stocks that are performing better than the average. If the S&P 500 is an average, look for stocks that are performing better than the average. That way you get better than average returns. So I look for the bigger moves using the higher time frames. I'm not a day trader. In short, guys, stay away from day trading. It just doesn't work, okay? Right, let's start with the monthly time frame. So we know that since 2009, the market has been bullish. The last real bear markets were from 2000 to 2002. That's the decline here. If you look at this decline, you're looking at a decline of roughly 50%. Then we had that recovery. Price came to this high point, which was the high of the decline. And then we had the decline between 2008 2007 and 2009. So that high point there is from 2007. That low point is from 2009. And you're looking at a decline of roughly 58%. So these were the last two bear markets that we were faced with. Now, the low of 2009, March 2009, from that point there, we've had this real significant run in the market, the longest bull run in history. That is a climb of over 600%. We take our markers we're looking at a climb of over 620% roughly. And then we have the high of this year, and then price has since been corrected. Now, if you look at the decline of this year, you're looking at around 25, 26%. So nowhere near the declines of the bear markets from 2000 and 2007. If the market does continue and we do start seeing further weakness, particularly if it breaks the lowest point of October, then we could say that we are potentially in a bear market. But up until this point, the market has simply been correcting. Now, I've got two markers here. I've got the high of last year and the low of last year. These are tools that I've developed that will automatically highlight the highest point of last year and the lowest point of last year. And you can see that price. The reason why I have this is because, first of all, it helps me to establish a bias. So if price is above the high of last year, it has a bullish bias. If it's trading below the low of last year, it has a bearish bias. If price is trading inside these levels, as it has throughout 2022, it's more of a correction or even a sideways market. And also, these levels act as key levels of support and resistance. So you can see that price came around this level, found support, and it's now started moving to the upside. Now, if we have a look at the last three candlesticks in more detail. So this is October, right, a bullish month. November started bearish, ended bullish. If you look at December, it started bearish, and we're now starting to see momentum back to the upside. So this is really important, because if the market continues to the upside through December, that will be potentially a strong sign that we could see a continuation to the upside through the rest of 2023, particularly if the market closes above $4,000, which is a key level as well. If the market closes above that level, we're likely to see further strength. Okay, now let's move across to the weekly time frame. So if I just compress the weekly time frame, what's important about looking at the weekly time frame, if I just go back to those bear markets of 2000 and 2008, we can see, let me just bring across some more data. Okay, we can see that it was around 2001 where the market broke through the black line, which is the 200 simple moving average. We had weakness to the downside. So that is when we really started shorting the market, because that is a true bear market. Again, here in 2008, price broke through the black line, which is the 200 simple moving average. Again, we had good weakness to the downside. So again, when you want to be shorting the market. Now, since this point here in 2009, the market has recovered, broke through the 200 moving average in 2010. And since 2010, it's been using the 200 simple moving average as support. You can see here, 2011, we had a bounce. Price came back to the 200 moving average in 2016, had a bounce, came back to the 200 moving average in 2018, had a bounce. Now, this is Corona. Okay, and you can see that Corona had as with all black swan events, it tends to have some kind of impact short term, can be quite significant in terms of the impact, quite scary as well if you don't really know how to manage these periods. And then what happens is the market absorbs the black swan event, and then it continues in the direction prior to the black swan event. And that's what we saw. So we can ignore Corona. We can see 2008, the market bounced and had a really big run to the upside. I mean, if you're looking at the run from the last bounce to the high of this point here, you're looking at a 105% bounce. So the fact that we've seen a correction is not surprising. We can't expect the market to continuously be creating highs. That's where people go wrong. These sort of corrections in the market, they're healthy, they're expected. And, if you don't get in tune with this, you'll always struggle. So what tends to happen is that you want to hold your stocks, whichever sectors they're in. Now, in this point here, the money was very much in the tech sector. A lot of tech stocks did very, very well. But what happened during this recent correction of this year is that these tech sectors tanked very, very quickly. So you want to be able to hold those stocks during the run. And then when you see the correction coming in, you want to take your profit at some point, tighten your stop losses. Now, let's have a look at what's happening right now. The market in October came back to the 200 moving average, and it's now bouncing. Where is it sat? Well, current price action is finding resistance at this orange line. This is the 50 simple moving average. These are proven levels of support and resistance, guys. This goes back to before the internet. Institutional investors and traders also use these indicators. So you want to align yourself with the institutions. You don't want to invest or trade like them. They have a very different approach, but you certainly want to be able to do your analysis in a similar way. And then once we identify where the trends are and the momentum is, we can then jump on those trends and just piggyback the ride. So the idea is that the institutions are doing all the hard work through fundamental analysis and paying for the information early. And because they're creating the trends and the momentum, we can use technical analysis, which is charts, to identify where they are, jump on their back, piggyback the ride. It's a far simpler approach. So what are we waiting for? What we're waiting for is the market to close above the 50 simple moving average, which is this orange line. Once it closes above the 50 simple moving average, this is likely to suggest further strength. Now, what you'll also notice is that I have a trend filter. I have bars where there's periods of green, periods of red, and periods of grey. This is a trend filter that I have identified, which will help to clearly establish whether we are in a bullish, bearish, or a sideways market. So you can see from the recovery from coronavirus, June 2020, up until December of last year, lots of green bars suggesting a nice bullish trend. Since that high point, we've been in a decline because we have a mixture of red and lots of grey. I would like to see far more red in a true bear market, a lot more red. But the fact that we're seeing grey is more of a down to sideways market. So for me, a standard side market as opposed to really a bear market. What I'm looking for now is momentum to the upside, the trend filter to turn green again. And once the trend filter has turned green, that will be an early sign of bullish momentum and when I will start buying stocks. Now, let's go to the daily time frame. By the way, guys, this is the S&P 500 mini. So what we're looking at here is pre-market action. So the market will open at 2:30 p.m. UK time. When that market opens, I then switch to the actual S&P 500. I don't really pay too much attention to pre-market action. For me, the most important indicator is the closing price, because the closing price factors in all the news for the day. It also factors in the institutional money, which comes in the last couple of hours really of the day, and we get a nice looking candlestick. We get a lot more information from the end of day candle rather than the pre-market candle. But it's always interesting to look at pre-market. The reason for that is because if we look at what's happening pre-market, we can see that there's been a gap up and we're seeing a continuation. So wherever the S&P 500 mini is at the open of the US market is generally where the US market opens. So there's likely to be a gap up, unless, of course, we see a complete drop in price in the next couple of hours. The market is likely to gap up. And if it gaps up, then we could see momentum to the upside. And if that momentum takes price above the 200 moving average, then that is a strong sign that we could see a continuation to the upside. So let's just look at this in a little bit more detail. The black line is the 200 simple moving average. And we can see that if we just go back to Corona, this was the decline. Let me just make it a little bit clearer for us. Just go back in time. Okay, so this was the decline around the coronavirus. So, there was a significant drop in price, roughly around 30 something percent. You had 35% from the high of February to the low of March. Obviously had everyone panicking, but price found support. We saw a recovery to the upside, broke back above the 200 moving average in May 2020, came back to retest it, found a little bit of support. And then from that point on, it went on this march to the upside. Let me just compress the chart so we can get in more data. And it went on this big march to the upside, found an end of the trend in January of this year. And since then, it has been in a correction. Now, let's look at the correction in a little bit more detail. We had a move below the 200 moving average initially. Then we had a surge back above it. This failed and led to the next move down. Price came back to the 200 moving average, failed, declined, found support. Now, where did it find support? It found support at the weekly 200 moving average, which we've already looked at, and also the lowest point of last year, which we looked at on the monthly time frame. So strong areas of support. Now, you may not believe in this for whatever reason. It's a little bit foolish to not believe in it. The reason why it's a little bit foolish to not believe in it is because we can see that is what the market is doing. Right, I've just seen a comment come through. Hi, Mailbox. Nice name. Good to have you with us. What indicators am I using? Good question. I am using my proprietary indicators, which are quite simple. I have on the monthly time frame, I have the highest point of last year, the lowest point of last year. The black lines are key levels of support and resistance. On the weekly time frame, I have the 200 moving average, the orange line, which is the 50 simple moving average, and a trend filter I have developed, which tells us periods of bullishness, bearishness, and stand aside, and the same indicators on the daily. So the daily mirrors the weekly time frame. The only difference on the daily is I have the blue line, which is the 20 simple moving average. So what I'm looking for is all three time frames to tell me I'm bullish, or all three time frames to tell me I'm bearish. If there's a mixture of bullish and bearish factors, I stand aside. Okay, I hope that helps. This is recorded, so if you want to go back in and review it, you can, of course, do that. So going back to what I was saying, guys, a lot of people think technical analysis is hocus pocus. Technical analysis has been around way before the internet came around. It goes back decades. Some of the finest traders and investors have used technical analysis since the dawn of the financial market. And what's beautiful about technical analysis is that it focuses on price action itself, particularly if you're looking at technical analysis on the higher time frames. Where a lot of people are going wrong is that they're looking at technical analysis on the lower time frames. They're day trading, 5-minute time frames, 15-minute time frames, 1-minute time frames. A lot of noise and a lot of inconsistency, and how people end up losing a lot of money. Whereas on the higher time frames, we can clearly see a direction in the market, and you can clearly see levels where markets are bouncing from. So you can see on the monthly that price is bouncing from the lowest point of last year. You can see that it's gone up. You can see that the market is bouncing off the 200 moving average. We can see it physically. Now, at this point here, it could have gone in any direction. It could have gone up, it could have gone down, it could have gone in any direction. But based on historical patterns, we know that the 200 moving average has a very high chance of pushing price up. There's no guarantees. This is why you want to wait and apply patience and let the market do what it needs to do. By applying patience, we're seeing a bounce. So now what we need to do is we need to see something similar on the daily time frame. We're now back at the 200 moving average. And if you look at a little bit more detail, price is currently below the 200 moving average. Okay, it popped above it earlier this month. You can see at the end of November, 1st of December, it popped above it, came below it. It's now finding some kind of support. We had a bullish move to the upside yesterday. We've had a gap up and a bullish start to the day pre-market. So we now need to see how the day ends. Today being Friday, we want to see how Friday ends. And with Friday ending, we of course get the end of the week. And by getting the end of the week data, we have an idea of what we could see going forward. Now, what do we need to see? Well, in a little bit more detail, we want to see the market close above the 200 moving average. In addition to that, we have this point here, which is the highest point of December. If the market can work its way above the highest point of December, then what we have is a continuation of the trend. Okay, once price starts creating higher highs and higher lows in a trend, so you can see here is a higher high here. So let's take it from this point here. We had a higher high, then we've got a higher low compared to this low. Then we've created a higher high compared to this high, and the market is now creating a higher low compared to this low. So if we see this pattern going forward, if I just grab my pen, if we see this pattern going forward, which is a move down, move down, move down, and so on, this is the structure of a trend. People generally tend to overlook this really important key feature of the market. The market doesn't go green bar, green bar, green bar, green bar. It moves in a particular way. It moves up, it comes down. It moves up, it comes down. Then it may move sideways for a bit. Then it continues going up. This is what is known as a trend. And a trend has a particular structure to it. If you embrace this, you'll be handsomely rewarded because you apply patience, you allow markets to come good, you allow the stock to come good. And each time the market breaks out and you're holding a stock, you can actually buy more of that stock, which is known as compounding. Okay, so this is really what we want to see now, guys. We want to see by the end of today, let me just remove this. Excuse me. Yeah, good. What we want to see, excuse me, let me just go back to my crosshairs. Yeah, what we want to see is the market close above the 200 moving average, and we want to see bullish momentum to the upside. If we get that, guys, we're in a strong position, because what we've identified is the very start of the next bull run in the market. And what we know, based on the monthly time frame, that bull runs in the market can last very, very long periods of time, 10 plus years potentially. Okay, so this is what I'm waiting for. Questions come through. Abdi, I'm just going to say your first few letters. I hope I got that correctly. Which strategy do you use? I'm a trend follower. Okay. So what I look for are the big moves in the market. I generally risk very small amounts of my capital, 1%, 2% per position. I spread my risk across very good stocks. The ones that lose, the losses are very small because the losses are part and parcel of trading. So if I buy 10 stocks, let's say two or three of those might be losing positions, so I lose 3%. Three of those positions may be break even, where I don't make any money, don't lose any money, so I'm still 3% down. But those remaining four positions that are open, they could all return me 10, 20% each over 12 to 24 months. Minus the losses, you can then see how I grow my account. And that's how I typically approach the stock market. That's my strategy. I am a trend follower looking for the big moves in the market. Okay, so guys, that is the S&P 500 mini. Once again, we've had a gap up so far. We are seeing momentum to the upside. Let's wait to see how the market closes. If it closes above the 200 moving average, then we could see further strength to the upside. Let's just have a look at that's the S&P 500. Let's just have a look at what's happening on the other indicators. The other indices. So the Nasdaq we can see is trading below the lowest point of last year. If I open up the monthly time frame, it's trading below the lowest point of last year. We want to see it move above the lowest point of last year and start working its way up to the upside. If you just go back to the S&P 500, we can see the S&P 500 is already above the red line, which is the lowest point of 2021. The Nasdaq is currently trading below it. And there's no surprise there, right? Because the tech sector has taken a huge hit this year. So the fact that the tech sector has taken a huge hit, the Nasdaq, of course, will have weakened far more significantly compared to the Dow and the S&P 500. So this is why you don't want to get caught up in brand names like Apple and PayPal and Twitter and Microsoft. What you want to focus on is the performance of the stock. You want to look at the indices and let the indices guide you on whether we're in a bull market, a bear market, or a standard side market. Once we've identified the right market, we then want to scan the sectors. So this is my process. I scan the sectors, looking for the strongest sectors. Once I've identified the strongest sectors, I then shortlist the strongest stocks in the strongest sectors. And I repeat that process again and again and again. So I've got scanners, I've got tools. You can see all the scripts in TradingView that we've developed. This helps us to really identify very objectively where the momentum is, where the money is, where the trends are. And this way, I don't get caught up in all the news on social media or on our media channels, on the internet, on Facebook forums, WhatsApp groups, Telegram groups. It's just mayhem out there. You have to focus on the chart, focus on your future, focus on what's the best way to get from where you are right now to the wealth that you want to generate. And the best way to do that is to use technical analysis, to use charts, and to use long-term strategies. None of this day trading malarkey does not work, guys. Okay, now if we look at the 200 moving average, you can see weekly time frame price above the 200 moving average, which is a good sign. Okay, if we go back to the S&P 500, it's already bounced. The Nasdaq is working its way above the 200 moving average, so it's got some way to go. And of course, on the daily time frame, still trading below the 200 moving average. If we go back to the S&P, it's finding resistance at the 200 moving average. The Nasdaq still hasn't touched it, but with the S&P 500 increasing in price, we can expect the Nasdaq and the Dow Jones to follow. Okay, but look, interestingly, if we go to the Dow Jones, which is next, the Dow Jones is very much leading the way, moved up quite significantly. It's approaching its current all-time high. So if we go to the Nasdaq is very much off its all-time high. If we go to the S&P 500, it's still some way off its all-time high. So the Dow Jones is very much, leading the way. What's interesting now on the Dow Jones is look at the weekly time frame, guys. It's moved back above the 200 moving average. The trend filter has turned green, and it's also above the 50 simple moving average. If you go to the Nasdaq is still below its 50 simple moving average, and the S&P is finding resistance at the 50 simple moving average. We want the Nasdaq and the S&P to move above the orange line, and we want the trend filter to turn green. So if we go back to the Dow Jones, we can see the Dow Jones is leading the way, which is a strong sign. That's okay. You know, indices tend to swap which one leads the way, which one declines quicker. It happens year on year. I stick to the S&P because that is my primary indicator. So once the S&P is set up, then I start buying start buying the right stocks. And if we come down to the daily time frame, look at the Dow Jones, guys. It's above the 200 moving average. The trend filter is green. It's pulled back to the 20 simple moving average. What we want to see is a bounce off this area and a move to the upside. Now, with the Dow Jones, if you look at where it is, it's in relation to this previous high from August. Came to around this level, did a little pop and a drop, pop broke above it, has now dropped below it. This doesn't mean the end of the trend. This could simply mean just a pullback before a move to the upside. And that's why we want to wait. We want to let the market dictate. And once it starts creating these highs, then we can start making better decisions. Of course, what we could see here is the market come back down to the 200 moving average. And so by applying patience, we haven't jumped into stocks too early. But once again, let's just have a look at where the NASDAQ is. If we look at the NASDAQ in relation to, excuse me, what's going on here? If we look at the NASDAQ is still way below the 200 moving average. And if you look at the the S&P, it's finding resistance at the 200 moving average. So what we want is the S&P and the NASDAQ to catch up with the Dow Jones. It's above the 200 moving average. It's finding some kind of support, hopefully, and we can then start seeing momentum to the upside. Okay, so that's really where we are, guys. I thought I'd do a quick update because we've had that gap up pre-market. Let me just go back up to the S&P 500 mini just so that you guys can see for yourself. We have had that gap up at the start of Friday pre-market. We are seeing bullishness. If that bullish momentum can continue and take price above the 200 moving average, that will be a very good end to the week and potentially a strong sign that we could see further momentum through the rest of December. And remember, guys, December is synonymous with the Santa Claus rally. Towards the end of December, Santa Claus likes to come and push the market up. And if you're positioned correctly, if you've got good stocks in your portfolio, so for example, McKesson Corporation, this is in my portfolio. I've been holding McKesson Corporation since last year, and you can see how well it's performed for me. So even with the decline in the S&P 500, McKesson Corporation has performed very well for me. It's in my portfolio. ABC, Amerisource, this is another stock that I've been holding since last year. You can see it's been a little bit bumpy, but it is starting to move to the upside. So there's lots of these stocks that are starting to emerge that we want to keep an eye out on. Arch Capital Group, good history of performance, created a consolidation. It's now starting to move to the upside. You know, if you can get in early in these stocks, and look how cheap this stock is, guys. This is only around $60. So if this moves to $100, $200, $300, this will be a fantastic stock to have in your portfolio. You know, another stock is Booz Allen Hamilton. It's another stock that's performed well in the past. You can see it's performed well. It's gone through a bit of a consolidation. It's now starting to break out. And if it can push further up towards $200, $300, and we time our entry correctly, these could be very, very profitable stocks. Now, if you want to jump in right now, just be careful. There are risks because the market, we've looked at the S&P, it hasn't fully confirmed a bull market. And that's why you want to apply patience. If you do jump in now and you want to get in early, make sure that your risk is well managed, typically 0.5%, 0.25%, less than 1% per position. When the market dictates a full-on bear market, that's when you can go in a little bit harder, risking 1%, 2% per position. I never risk more than 2% per position. Okay, I like to take small risk, but spread my risk across many stocks. Okay, I think that will be a great place to end today's live stream. I'm just going to go over to the questions. I'm just going to hold tight for a couple of minutes just to make sure that no one has any questions coming through. I seem to have answered all the questions so far. Guys, do follow us on TradingView so you get notified whenever we go live. If you have any questions, you can reach out to us via direct message. We put up ideas on a regular basis. So if you follow us, you can get the ideas. You can leave questions on the ideas as well. And myself and Collar, my partner here at Sublime Trading, we will happily get back to you and answer any questions that you have. Do check out the link as well in our signature. That will give you access. If you opt in, you'll get access to our stock market blueprint. It goes through the 3 steps that we have created on how we identify and invest in stocks. So step 1, step 2, step 3, all clearly explained. Okay, Looks like there aren't any questions coming through, so I am going to end the stream right here. I appreciate everyone that's watched it. If you're watching this on recording, appreciate your time as well. On YouTube as well, appreciate your time. Do get in touch with us. Interesting times again in the market. So if you want to position yourself correctly and you want to learn how to trend follow and get on the right side of the market, do reach out to us. We've got some great trading academies that we can help you with. All right, guys, have a lovely Friday and an excellent weekend, and I will see you guys next week. Take care. Cheers. Bye-bye.